Tax planning is a critical component of your entire financially well organised strategy, and again must always be aligned to your goals and objectives. A tax plan isn't around chasing tax deductions to pay the least amount of tax legally possible. Yes, deductions are really important, but it's about structuring your affairs so that the average rate of tax that you pay on all of your income and all of your profits that you earn is the lowest rate that is legally possible. And it's the same with your assets. When you sell those assets and you make a gain, you want to pay the least amount of tax legally possible. That tax is called capital gains tax, and the structuring of the ownership of those assets has a significant impact on the amount of capital gains tax that you ultimately pay. So the key element to a tax plan is getting the structure right around your income and asset ownership. It's looking at what type of entity you operate your business in so that you pay the least amount of tax possible, and that could be via a partnership, could be via an individual, it could be via a company or a trust. If you're looking at the ownership of an asset, those assets can be acquired within any of those entities as well. But in addition, you could also own an asset within superannuation. For example, your business premises could be owned within a superannuation fund that is leased back to your business. So as an individual, you may pay tax at anywhere from 0% to 47% of your income, depending on the amount of income that you earn and how much applies to the different tax brackets in between. Companies pay tax at either 25% or 30%, and superannuation funds pay tax at either 0% or 15%. So a tax plan looks at your income and looks at where that income is earned within those entities, and is designed to ensure that you pay the least amount of tax possible by averaging that rate out. Now, there are tax laws that you've got to comply with in terms of how you do this, but it's important to really understand what those goals and objectives are and then align your structuring to that. Ownership of your assets is also very critical because the capital gains tax rules will apply differently depending on which entity owns those assets. Individuals and trusts, for example, where an asset is owned for more than 12 months, will enjoy a 50% tax-free discount on any capital gains that it makes. These capital gains aren't available to companies. Companies pay tax on the full amount of their capital gain. However, there are also small business capital gains tax concessions that can apply that can render capital gains within a company, as an individual, or within a trust, tax-free within certain limits. Within a superannuation fund, the taxes is also different. Where a super fund has owned an asset for more than 12 months, 1/3 of that capital gain is tax-free, and the balance is taxed at 15%. However, if those assets are sold when that superannuation fund is in pension phase, so when the members have retired, then the superannuation fund doesn't pay any tax on those pension accounts. So effectively, getting the timing of when you sell an asset to be after when you've retired could render that profit tax-free. So when it comes to developing your tax plan, think about these issues, and as always here at FWO Chartered Accountants, we're ready to help you be financially well organised.